Did you know that the numbers that you use to file taxes and the numbers that you use for day-to-day strategy are actually very different? What up gang, this is Michael Su from Deep Sky. Today I'm going to talk to you about the difference between business accounting and tax accounting. You see, business accounting and tax accounting are fundamentally very different. Let me give you three differences. Number one, accounting for strategy needs to be on accrual basis. Here's why. Because accrual basis means that you're accounting for the best reality and you're doing your best at matching your expenses to your revenue so you can see exactly for every dollar I spend, how much money I'm making back. Cash accounting, on the other hand, is what we do for taxes so that we only pay taxes on the money that we have earned and received. So then you're not stuck with a huge tax bill that you have no money to pay for. Second thing, depreciation. Now, when you buy a piece of machinery or equipment for your business, that piece of asset have real value. You need to keep that value on your books, on your balance sheet, so you can do a few things. You can see how well your assets are turning you profit, or when you're ready to sell a company, well, your company might be worth something because that asset is worth something. However, on a tax perspective, we want to depreciate that as quickly as possible. And you know what? The IRS allows you to do that. For example, Section 179 allows you to deduct up to a certain amount in year one of your entire equipment. Now, we would definitely want to do that for taxes because it saves us on tax bills, but then we don't want to do that for our day-to-day strategy. Third thing, meals and entertainment. Entrepreneurs understand that your network is your life. Now, how do you build and maintain your network? You go out and you spend time and money with the people that really matters with you. Your most important customers, most important vendors, and your most important partners. As CEO of a company, this is one of your primary job responsibilities. And you know what? These are legitimate business investments. However, the IRS sees it differently because they think, you know what? You have to eat anyways. So they only allow 50% deduction. So there you have it. These three things are just easy, quick, top of the mind things that I can come up with that are the differences. But then the truth is there are a multitude of differences between book and tax. In fact, there's so many differences that the IRS totally understands it that they created a thing called the M1 schedule, and the schedule is called book to tax adjustment. Now, the right way to do it, instead of having your tax accountant to take their tax adjustment and book it into your financial statements, so then that's confusing you, what you need to tell them to do is keep all of their adjustments on this M1 schedule, the M1 schedule that accounts for all of the difference between the truth and then the tax law, and then finally the set of numbers that you're filing your tax return on. Until next time, I hope you guys are growing profitably.